Now, if you clicked on this video, it's because you want the knowledge to succeed in the stock market. I believe that we are on the cusp of a once-in-a-lifetime opportunity to change our lives financially. The presidential election in the United States and the volatility that follows will bring such opportunity. I spent years listening to experts on CNBC talk about this stock or that stock, basically for nothing. If you want to skip years of buying and random stocks and hoping for success, then stay tuned. So, what is the stock market? I like to think of the stock market as a basket of financial assets with each egg representing a different asset, such as stocks, otherwise known as equities, bonds, commodities, currencies, cryptocurrencies, options contracts, futures contracts, as well as different types of savings accounts with tax advantages to them. Why would a company go public, also known as an initial public offering or IPO? Basically, they go public to access capital, money that they need to continue buying whatever product that they sell or to hire employees to provide whatever service that they provide. Now, the stock market for us as retail traders or normies access the stock market through a broker. Different types of brokers offer different services. So Coinbase will give you access to the cryptocurrency market, but traditional stockbrokers will mostly only give you access to everything that I listed previously except for cryptocurrencies. Brokers such as Webull, Robinhood, and Charles Schwab, which recently merged with TD Ameritrade, are some good options. Now, I'm not going to get into exactly how to open and fund and use your brokerage account, but it is pretty easy and straightforward. If you have any questions, there are tons of videos on YouTube that you can use to get started. So with that being said, there are two main ways to analyze the market. The first being fundamental analysis. This refers to factors such as debt to income ratio, earnings per share, ownership percentage of the company, and market cap, book value, as well as the total value of the assets themselves. Secondly, we have fundamental analysis, and this refers to factors such as stock price, trends, volume, key levels of support and resistance. Speaking of stock price, let's say, for example, you were to buy one share of Apple stock. Right now, as of this filming, that would cost you $191.11. Tomorrow, it could open at $192 and you would make $1 per share. Or it could open up at $190 and you would have lost $1 per share. And I say that because now we're going to get into the different types of investing. There is dividend investing, so people going into the stock market and looking to buy stocks specifically for the purpose of collecting that dividend. And it really depends on the company, how much they pay. So you do have to do your research on that. Some companies pay 1% in dividend per year. So if it's $100 stock, they're going to pay out $1 per year for every stock that you own. Other companies pay out 5%, some pay 10, some even a little bit more, especially the oil companies. When the oil price is really high, they can get up to 15% dividend payments. The second is swing trading. So swing trading is basically you buying a stock and holding it for more than a day, but usually less than a year. Then we have day trading, which I personally partake in. Day trading refers to buying and selling a stock in that same day. So you could buy it in the morning at 7:30 Mountain Standard Time when the stock market opens and sell it before it closes at 2 p.m. Mountain Standard Time, and that would register as a day trade. There's also long-term buy and hold strategies, which refers to you buying a stock and holding it for more than 1 year. So with that in mind, let's talk about which stocks to actually buy. You can do your own research, and when you do your research, you can look for what your investment objectives are. So like I stated previously, you could buy an oil company for the potential dividend payments that it will pay out in the future, or you can buy technology. And there's a couple of different ways that you can go about it. You can either buy an individual stock, for example, Apple or Tesla stock, Or if you don't want to deal with the hassle of researching and looking for each and every single individual stock that will make up your portfolio, you can buy a piece of an index, such as the S&P 500 or the NASDAQ Triple Qs. And this will take a lot of the work out for you because the S&P 500 has 500 of the top companies in the entire stock market. And just for reference, there are more than 4,000 companies publicly listed in the American Stock Exchange. If you are going to go the route of buying individual stocks, here are some tips that I have found to be extremely successful for me over my 7+ years researching stocks. Number one, you want to buy stock in a company that is either inventing a market or dominating it. Number two, you want to buy shares in a company that is taking market share. So it could be, for example, a couple of years ago, I remember Celsius was on fire and it was taking a bunch of market share away from other alcoholic beverages like beer and spirits and stuff like that. So that would have been really good for the inventing a segment / dominating it and taking market share / disrupting an industry. You also want to look for a company that is in a sector, in an industry that is poised for growth overall. Also, you would like to look for, in terms of at what point you would want to buy, you would want to look for the point where it's a technical breakout. So where it had a previous high price, and then it probably came down after rejecting that high price and broke above it. Because in that moment, you're going to know that all of the previous people that shorted the stock, which is, I know, is a more advanced concept, and we'll get into it in another video. But basically, there's going to be more buying pressure because shorts are going to look to cover, and then other people are going to see that it's at a 52-week high. There are 52-week high scanners. We're going to get into scanners in another video also. And then it'll become more momentum that'll drive the price higher, and you will be able to benefit from that. I also highly recommend that you look for a company that is developing new streams of revenue. So the whole point, like we mentioned earlier, of a company going public is so that they could get money, they could raise money, partly to buy whatever product that they're selling or manufacture whatever product that they're selling, but also so that they can use that money to develop, research and development, new products. So if you see that they are constantly coming out with new products, that means that they are growing, they're gonna be growing their income stream. And also, this isn't gonna net you the most amount of money the fastest, but it will be a safer way to invest your money. And that is gonna be to buy the incumbents that are already the top players. So you could look for the next Apple, right? Or you could just buy Apple. It's gonna be a lot easier. And to be completely honest with you, these gigantic corporations actively gobble up and buy or destroy their competitors. So you're going to be putting yourself in the best position to succeed and profit by just buying stocks in the companies that are already the multi-billion-dollar heavyweights. And lastly, you want to always be asking yourself, what is the economy doing right now? In my personal experience, last year, just as one data point, we saw hurricanes in Florida that they wrecked a bunch of places. And so stock in a company that's ticker symbol PPSI, and ticker symbol is basically the stock market's shortened abbreviation of the stock company's actual full name. And you saw the stock price of ticker symbol PPSI, which manufactured the, what are they called? Manufactures the mobile generators. Yeah, the generators that create electricity, went up. Another example, when the war in the Ukraine happened, the stocks of the military industrial complex, such as Lockheed Martin, went up 20%, basically in one day. So that was a pretty good profit. So you want to always be paying attention to what's going on in the United States economy, in the world, and you can profit from them. Also, I want you to always remember that the stock market looks to the future, okay? It doesn't care that a company was the biggest company in America 50 years ago, such as IBM at one point in the 1970s. It was the largest company in the United States, and now it's a shadow of its former self. I remember when I was growing up as a kid, Sears was the biggest retailer in America, and now it doesn't even exist anymore. It went bankrupt, got delisted, and it's gone now. So you really want to focus on what do you think, based on your research, will be worth more in the future. And that can be a little tricky because you want to believe in the hype enough to put your money behind it, but you also have to be able to recognize when that hype train ends. And, some stocks like NVIDIA have been able to benefit from multiple hypes, like forms of hype. Other companies, they just have a one-trick pony, and because they are not developing other products, they can't sustain that momentum, and then their stock price falls off. So really pay close attention to this criteria that I laid out, and you will be in really good shape when you are picking and looking for the individual stocks that are going to make up your portfolio. Also, too, just in my personal opinion, you should have at least 3 to 5 stocks in your portfolio. You don't want it more than that, because then you're going to start to expose yourself a little bit too much. And lastly, I want to talk about risk management. So basically, one thing that I want you to remember when we're talking about risk management is that don't put any money, don't deploy any capital that you can't afford to lose every penny of. The stock market, unfortunately, from its inception, was created to take money from normal people like you and me and give it to companies. Nowhere in that statement did I say it was designed from its inception to make us money, because it was not. It was created so that companies would have access to the money that they need to research and to do research and development, to hire more employees, to buy more product, et cetera, et cetera. So with that being said, CEOs and CFOs will do some shady things to try to prop up their stock price, or to try to generate more, money for their company. And sometimes we talked about an IPO, an initial public offering. So that's called initial because they could at some later point issue more stock. And issuing more stock will dilute the value of the stock that we already own, because it'll be more supply but not more demand, and it will disrupt the supply-demand imbalance. So you do want to keep your eye out for that, and you do want to always remember that, even though there are, such things as manipulation and liars and cheaters in the stock market, that as retail traders, we still have some advantages and things that we can do to take advantage of their inefficiencies. Something that I look forward to getting into in future videos. If you like this video, smash the like button. Check out my links down below if you want to join my trading community and learn more and be a part of a group that helps each other learn and grow. Thank you so much, and I'll catch you on the next one.